Welcome back to Wealth Mavericks, the only show where we talk about the secrets the wealthy know to build generational wealth. And on today's episode, we're talking about asset allocation for the different life stages. So like 1 in 10 families that's out there actually has a plan. And then of those plans, again, there could be good advice, there could be bad advice. It may or may not be appropriate, but only 1 in 10 actually has that. But don't just continue to operate in this realm like the vast majority of people are, without a plan, without a safety net. And they live by the axiom, the more you make, the more you spend. They just start spending that money. And that's not what the wealthy do to build generational wealth. They are intentional about building something. I'm excited about this topic. I think a lot of people could use this information. And Bob, I'm sure you've seen this probably more than I have, where people, it's what's that rotisserie chicken guy, Ron something, the set it and forget it.
I don't remember that.
Set it and forget. It was like his whole thing. I think a lot of people, like with their financial planning, with the asset allocation, like they said it 20 years ago and they have forgotten about it. And so I think it's an important topic for people to be taking a look at. So talk to me about your thoughts. What do you know about asset allocation over the various stages of life?
Yeah, no, thanks, Joe. Well, before we jump into that, let's just make sure this is clear that people understand that we're not giving financial advice right now. This is just educational and informational purposes only. Just want to make sure you understand. We don't know your situation. So we're just talking in, not necessarily theory, but just in an overall 30,000 viewpoint of not knowing who you are as the listener and your viewpoint. So just, this is more just education, and take notes. And if you have specific questions or you want to actually have a dialogue on one-on-one, then you're welcome to reach out to us in our office, and then we can have that dialogue. But just wanted to throw that very important disclaimer out there before we jump into things here.
Sounds good. That's like when you're watching the commercial of the cars and they're just driving on a very normal road at a very normal pace, and it's like, do not attempt professional driver close course. I'm like, no, that's like John on Saturday.
Yeah, exactly.
But I hear what you're saying. That's good disclaimer.
Now when they're showing crash dummies,
yeah, that's a different story.
Yeah, that really does make sense. But I just saw a meme that said, hey, you know what, I'm not saying get rid of all the stupid people, I'm just saying let's just get rid of warning labels and let them take care of it.
Right, they'll sort it out.
They'll sort it out. Natural selection, I guess, right? Anyway, so I guess the biggest thing is that just first, right off the bat, I think in this particular topic, Joe, is that there's a lot of opinions. I mean, you could talk to 10 financial advisors, you can talk to 10 insurance agents, you can talk to 10 CPAs, you can talk to 10 attorneys, you could talk to 10 friends, and everyone's going to have a different opinion. Every single one of them. You'll have 40 different opinions, and you're going to be sitting there going, so what do I do? I mean,
so what do those opinions range? Like what's the range of advice that you would expect from those 10 different people of all those genres?
Yeah, I think that's a good question. I think it depends on their personal experiences, what they're comfortable with advice, because most CPAs are very conservative. They don't really like to give a lot of advice, especially. But I have had CPAs give advice when they have no financial background. But then you also have financial advisors that give financial advice, and a lot of times the financial advice is driven to the same answer for every single client. And then you have insurance agents who may not have a securities license. They may just be insurance licensed. And so what's their advice? Typically, it could be focused on an insurance product. And then, you have attorneys that will give advice that's going to be based on law and what could possibly happen, or what law things, court cases that they've read and studied on. And so, and then you got friends and family that just have no basis other than gut and I heard, or I think, or I feel, and not all of these are right, and not all of these are wrong, and that's why they're called opinions. So I think when we're looking at this, I think from a specific purpose of you, what are you looking to accomplish, knowing that what you want to accomplish today is going to change later on, because we evolve and change as we get older.
Hmm.
And so understanding that as a process. So really, I think the thought process really should be not the what do I want to do now? It should be what outcome do I want to accomplish? What is the exit? What is the 10, 15, 30 years from now? What do I want to do?
Well,
Right.
and
And
that would be for someone who's younger, but someone who's older who may not feel that they've got that time, they're in a different position. And as you're talking about this, what it reminds me of that statement, if all you have is a hammer, everything looks like a nail. So
right.
your insurance agent, their hammer is insurance products.
Mhm,
And so
mhm,
that's what
mhm,
they're going to focus on,
mhm.
certainly.
Yeah.
But what are the, people who've got a longer horizon, generally speaking, what is it that they're looking to do as opposed to somebody who's perhaps nearing the end of what they see as their lifespan? That those are two different objectives like you're talking about. And I know
Mhm.
we were talking with someone not too long ago, and they were talking about what was it, signing like a prospectus or something like that. He's like, I just don't believe in that. Like
Yeah.
that's just legal mumbo jumbo. The truth is, like, your risk tolerance is based on what you're looking to accomplish.
Yeah.
If you've got big lofty goals that require a lot, you better have a high risk tolerance, because that's the only thing that's going to get you to the outcome you want. So what
Yeah.
does that look like in the various stages? Or what would you actually, here's a question. What are the various stages of life?
Yeah. Well, I think one of the things that I like to try to communicate is time equals risk. Less time you have, probably less risk you're wanting to take. The more time you have, you're probably willing to take more risk. But when you talk to somebody and you ask them, well, what's your risk tolerance, right? That's a industry lingo. Most people will say, well, what's that mean? And you say, okay, if your account were to lose money, what percentage of money are you willing to lose? What do you think everybody's answer is?
None.
None.
Right? I don't want to lose anything.
Right. I want to make 300% and I don't want to lose a dime.
Right.
Right. So
People find
every
out what their risk tolerance is after they lose money. It's like, oh, my risk tolerance was a lot lower than I thought it was.
Yeah, absolutely. And I think also a great example of this is the evolution of what we use or we have communicated. My other YouTube channel, I talked about the S&P 500 no longer being a benchmark as to risk and what the 500 largest companies in the nation look like, because there's 7 companies that drive the rate of return on the S&P 500, and the other 493% have averaged 4% return, and
Mm,
these 7 have averaged 17. There's no longer a benchmark, but I'm in Vanguard and I'm in the S&P 500 and Vanguard index.
hmm.
Your risk is no longer 500 companies. Your risk is now 7.
Right.
Right. So, I mean, so to answer your question, what's this time frame? What's this look like? Well, I think, the closer you get to retirement, again, what's your outcome? I want to build up enough assets to where when and if I'm no longer earning traditional income, whether it's a paycheck as an employee or a paycheck and profit out of your business, what does that look like and what do I want to accomplish at that stage, right?
Mhm.
We call it retirement because the industry wanted to drive people to understand you need to save money so they can start generating the financial distributors can start generating fees and revenue based on you putting money into that nest egg, right? We got away from pensions. Now you're responsible to save for your future.
Hmm.
Well, if that's the case, what does your future want to do? Do you want to travel? Do you want to spend time with family and kids? Maybe you're young enough to where you're not even married and you can't even fathom being married yet and having kids, right? But maybe you're married, you got 4 kids, or maybe you're on the brink of retirement or you're already in retirement.
Hmm.
That time horizon, that allocation changes. And traditionally, the older you are, the more conservative you are. But here's what happens when we start shifting to a tax mindset. The more conservative your portfolio, using traditional stocks, bonds, mutual funds, ETFs, using traditional investment equity markets, the more conservative you are, means that you're in investments that create dividends, interest, and there's less risk.
Hmm.
Well, what are dividends and interest on your tax return? It's income,
Income, right?
right? It's going to be taxed. Well, what if I don't need that? Well, you're older. You need to be more conservative, right? You can't take as much risk. Well, what's that mean? Am I of a family lineage and heritage where all of my grandparents lived into their 90s and I'm now 65 and I'm planning on retiring now or in the next couple of years? You could have essentially have a 30-year time frame. Think about that. If you're
Right.
65 and you have a longevity that could be 95, the last 30 years was 35 to 65. Think about that. What's happened from 35 to 65? Now you're 65 and possibly could live to 95.
Mm-hmm.
That's what a 30-year time frame looks like. So does that mean I'm going to be more conservative? I've got a larger nest egg. I'm going to be more conservative. I'm going to generate interest and dividends, create taxable income where I may not need that. And does that additional taxation cause me to actually have a less net amount with inflation, that now I'm taking more out, now I'm paying more taxes at retirement than I did in my working years?
Mm-hmm.
Right? So allocation, I think, is important, but I think your outcome is more important to understand what the situation looks like. Now, when you're younger, you can take more risk. Well, what does that mean? More appreciation means less tax, unless that particular investment is sold, and then there's capital gains on that. And if it's in a retirement account, you don't pay that until you take it out. If it's not a retirement account, then it's capital gains, and you pay that in your tax return that year.
Right. So,
So what's all
we
that
talked
look like?
about tax loss harvesting. So, I mean, we've already talked about how to help with some of that.
Yeah.
But what's like some practical tips for somebody, and let's just take maybe two or three different scenarios.
Mm-hmm.
Someone who's in their mid 40s, they're in the crux of building their business. You know,
Mm-hmm.
they are pouring a lot back into their company, but when there are those, you know, they want to take a traditional investment approach and their asset allocation, like where does someone begin? Does it
Yeah.
begin with like, let me identify those outcomes first of all, like,
Yeah.
and then make a plan based on that, or where would you say someone should start?
So if we're talking about a business owner, my answer is different than a traditional employee.
Okay.
Because a traditional employee, that answer would be probably just traditional equities market,
Mm-hmm.
right? Looking to see what that entails. Looking at probably funding your retirement account. But if is your company matching? Do we fund to the max where your company is matching? Do we Can we contribute to Roth IRAs? What's that look like? Right?
Right.
Can we have do we have enough extra income or discretionary income as an employee to where I can start funneling some money into cash value life insurance and start
Mm-hmm.
building up that nest egg to have tax-free dollars, and very similar to building up a Roth, but in a cash value life policy. And there's a whole bunch of strategies around that. We'll probably do a whole nother episode just on that down the road. That's probably a traditional employee. And the
Mm-hmm.
allocations would be, I personally think nobody should be more conservative than moderate, unless they're in their 70s and they have a time horizon of 10 years.
And is this like a radio button selection that they're making on their investment choices, or like how does this show up in their real world?
Yeah. For us, what we do is we do buckets, time buckets.
Mm-hmm.
And what I said before, time equals risk,
Mm-hmm.
right? So if I have a bucket with a shorter time frame, meaning 0 to 5 years, that means there's going to be more liquidity and cash type structure, more access to capital,
Mm-hmm.
right? Whether you're a business owner or an employee, that's that bucket, or you're retired. Then the next bucket would be a different time horizon based on your situation, your age, and the outcome. It could be 5 to 10 years, or it could be 5 to 7 years. There's going to be a certain risk associated with that. It's not going to be cash and liquidity. It's going to be something a little bit more, right? And then the next bucket, right? So depending on your age and depending on your situation, you could have anywhere from 3 to 5 age buckets that equate to time and risk. Obviously, the bucket that's farthest time away probably will have the most risk, probably will have a greater time frame, because that bucket is designed to appreciate and accumulate to, once you get closer to that, those dollars allocate into a shorter time frame bucket time equals risk, right?
And
Now, if we're
is the
talking about
theory,
business, oh, sorry, go ahead.
I was gonna say, is the theory behind this that the longer your time horizon, the more ability you have to recover from negative consequences of higher risk, you know, higher risk that happens? Is that the idea behind this?
Yes, but also let's refer to what most people in the consider risk. Allocation and diversification reduces risk, right? But you can talk to the most and read the most successful investor out there, Warren Buffett, and what he talks about as diversification is basically your inability to understand what you're putting your money into.
Right.
Knowledge, right? Warren Buffett is not diversified. He is very focused on exactly what he wants. Now, Berkshire Hathaway as a company owns multiple companies that are diversified in different industries, but that wasn't a makeup of plan design. That was, hey, this is a very profitable company. It's well ran. This will generate certain cash flow for our business, and we can do a whole episode on just Warren Buffett, and that may be something we want to do is what that looks like. Not a lot of people emulate Warren Buffett. We do.
Mm-hmm.
And so when we're looking at that longer time frame allocation, it's yes, you have more time to recover, but it's are you just flipping a coin and putting money into an investment where you just flip a coin and say yes, no? Heads is yes,
Right.
tails is no. No. There's
Which
this.
is that how most people you think are making decisions? I mean, if you just look at the average person who's out there, is that what they're doing, or do you think that how many people would you say that you run into that actually have a specific plan? Like they're actually executing on a plan with intention. What
Yeah.
percentage of the population do you think that is?
If I said 10%, I think I'd probably overestimating. How do
Wow.
you round? It's if it's four, you round down. If it's five, you round up,
Right.
right? So if I say 10%, I think I'm rounding up. It may
Wow.
be between 5 and 10.
So like
Uh,
1 in 10 families that's out there actually has a plan. And then of those plans, again, there could be good advice, there could be bad advice. It may or may not be appropriate, but
yeah.
only 1 in 10 actually has that. So I think that's something that I would love for people to understand, like in the spirit of this channel, right? The Wealth Mavericks podcast, what the wealthy know to build generational wealth. Part of the reason is like one, it's not modeled to us, so we don't really know what we're doing. Unless it is, if you have a good model inside of your family, you tend to continue that. But if you don't, like just know that there are outlets, like you can get good advice that will help you get ahead, and it's not going to happen on accident. You know,
Mhm.
it is going to take intention on your part. So I think for our average listener, I think they just need to understand, and we'd love to be that for you. But if it's not us, reach out to somebody, reach out to a qualified advisor who can give you specific advice in your world to accomplish your goals for the reasons that are important to you. But don't just continue to operate in this realm like the vast majority of people are without a plan, without a safety net. And what I've seen happen, or at least in my experience, with the people that I know and with, clients that I've spoken with, they live by the axiom, the more you make, the more you spend. They just start spending that money. And that's not what the wealthy do to build generational wealth. They are intentional about building something. Delay of gratification is missing in our society by and
Mhm.
large.
Mhm.
So how
Mhm.
do we recapture this concept of I'm going to live without a few things now so that I can live, I was it Dave Ramsey that said like live like no one else today so you can live like no one else tomorrow or so, something like that. It's like
Yeah, it's pretty
just
good.
break the model. Like
Yeah,
just
yeah,
don't just do that, but create a plan
yeah.
intentionally.
I completely agree. Excuse me. I completely agree with that. And what I'd like to do, Joe, is go back to your question because my answer was so far for somebody who is a traditional employee or a non-business owner, right?
Right.
Now, what would my advice be for a business owner? Would be definitely not the equities market.
Hmm.
For a business owner, one of my top suggested strategies and assets would be cash value life insurance because you can structure it to where you can help protect the business if you have key employees or you have certain employees that are very instrumental in the success of your business, by creating certain type of benefits for those employees and creating a financial connection. We call them golden handcuffs. You create
Hmm.
a financial connection where the business funds a deferred comp or some kind of benefit to that employee to minimize their ability to go to the competitor who's going to offer them, $10,000 a year more raise and pay
Right.
for their health benefits,
Which
right?
people are, I mean, this is happening left and right.
Yeah.
I can't remember if we were talking about this on the podcast or if this was just a different conversation, but this is this lateral moves with just this micro adjustment. People are leaving for a lot less than $10,000 a year raise because cost of living is increasing. It's like people are getting scrappy, and it's like, you're gonna pay me 5,000 more, I'll make that shift. And that's catastrophic for a business. And what I would love to do, I know that this is a highly controversial topic in the financial world, using cash value life insurance. I know you get big proponents for it and big detractors from it. What I would love to do is, I think this really belongs in our member only content. So I think we should explore this more over on the Wealth Mavericks member only topics, because I know you've got a lot to say about this. And I think when people hear really your perspective, to me, it's irrefutable. I mean, I cannot understand the other side when people really hear that. So, any parting thoughts for our regular listeners before we dive into the member only content?
Yeah, and I think to your point about employees moving lateral and moving employment for a lot less, think about those employees. That means that probably the majority of them are not funding their own retirement.
Right.
They're not contributing to the 401k plan that you as a company are offering. They're not putting money into their own IRA, their own Roth IRA, or into the pillowcase, right? Or the sock drawer. They're living on that money because in high school through college, we don't learn how to manage money. This is why most people are flipping a coin or not having a plan, and why most people are scared of taxes, because we're not taught the basics of what this means. And so it's very easy for someone to make a decision on what they do understand is, I'm making this, somebody can offer me this. That's an easy decision. I understand that. All the other good and bad consequences to that decision stops there. Right? And that affects not only the person, the employee who's leaving the company, but it affects the company who is missing out on that employee. And a lot of times there's not a dialogue of why that employee is leaving.
Right. The only dialogue is, this is painful and I want it to stop.
Yes. Yeah.
Right.
Yeah, absolutely. So let's jump over to members only content, and let's dive into this highly controversial conversation, because you're right. It really is. It's like civil war in the financial world.
That's exactly what it is.
It's crazy. So yeah, let's do it.
Well, that's great. Well, thanks for joining us on Wealth Mavericks today. If you want to be a part of the conversation, join us over on our LinkedIn or Facebook pages. Leave a comment here. Let us know what you thought. More importantly, what questions you have.